if you could learn some of our tricks, you can get more success out of life than you deserve. That's what's happened to me.
Charlie Munger is one of the most successful value investors of all time. His partnership in the 60s and 70s generated a 19.8% compounded return, while the Dow Jones returned just 5%. In today's video, I'm going to share with you the mental tricks that Charlie Munger spoke about in a recent speech that he says allowed him to achieve more success than he deserved. But before I show you the first clip, I am pleased to announce that Learn by Example is now open for April enrollment. Learn by Example is a platform and community that I run for a small number of long-term investors who want to gain more confidence and consistency in their investments by diving deeper into the analysis process. Students get access to 30 hours of stock analysis reports and 60-minute presentations, plus new ones are released every 2 weeks, which serve as case studies for developing an understanding of stock analysis. Students also have access to a private community of like-minded investors where you can participate in weekly Q&A live streams and have access to me Monday through Saturday for all your investing related questions. There are so many online courses out there right now that just repurpose information that you could find in a few $10 books, but they do not provide the learning environment that is necessary for you to be able to apply the principles that you learn in those books. And that is exactly what Learn by Example provides for its students. And on top of all of that, students also get access to the brand new Judgment Day module, which is a comprehensive step-by-step guide to the intrinsic value portion of the analysis process, which for many people is the most difficult part to nail down, figuring out how much cash a business can return to you and therefore what price you should be willing to pay for that business. For the next 14 days, you can get a whopping 30% off the regular price if you use the coupon code Easter at checkout. All of the links to information about everything that you get access to, as well as how you can sign up at the discounted price, is all down in the description below. So if you're interested, if you're a long-term investor and you're interested in diving deeper into the process, working closely with me, then check it out down in the description below and get yourself 30% off for the next 14 days.
I stumbled into a few mental tricks early in life, and I just use them over and over again. I mean, I take the high road because it's less crowded. Of course, that's a smart thing to do.
This first trick that Charlie Munger talks about is taking the high road, which for those who don't know what that means, it basically means doing the right thing, even though it's not always the most popular thing. And we see this in every area of our lives, but it is perfectly attributable, or perfectly applicable, I should say, to the investing world as well. Because what is the right thing to do when you're investing? Well, the right thing to do is that you should analyze the underlying business that you are buying a piece of and look at its long-term prospects in order to see what kind of return you would likely generate out of that business based on how much profit it's going to generate for you over a 10 or maybe even over a longer period. But this is not what most people do. This is not the popular route. The popular route is the one that most fund managers, most hedge fund managers, mutual fund managers, and in fact what most individuals take, which is to look at a stock as a price on a chart, to be trying to predict the price movements of a stock on a chart in the short term. And when I'm talking about short term, I'm not talking about day trading or even trying to make a profit in a week. I consider anything within 2 years or even within 3 years maybe to be short term, because businesses operate on cycles that can go over half a decade or even an entire decade, which means that anything over a shorter horizon is something that I would consider short term. It is at the mercy of short term impacts that could hurt a business for a 6-month period or a 12-month period. And the problem with having a focus on trying to find stocks that will go up over the next 6 months or the next 12 months is because it goes completely against the logic of analyzing the underlying business. There could be a fantastic business, but all great businesses go through short-term periods that are bad. So to avoid great companies because they're going through some kind of short-term problem, particularly because if they are in a short-term problem, their stock price is probably at a better price than it was before the problem arose, is just illogical, because fund managers will not invest in a company that will be a loser for a 2-year period. They couldn't do it. even though it could be the best time to invest in that company in order to have the best return over a 10-year period. They cannot forego the short term for the long term. And this principle doesn't just relate to investing, of course. It is relevant in every area of our lives. All the time, I see people, I think most people operate in this way. I think most people operate in such a way that they are more happy, they are more willing to follow the majority in the short term, even if they know it's the wrong thing to do, because they don't want to go through the short-term pain of going against the majority, even if the long-term outcome is favorable for them. What most people need to realize is that if you constantly do the right thing and you go against the majority in some circumstances, yes, in the short term, that might be painful, but over the long term, you will gain lifelong respect out of all of the people around you for sticking with your morals, doing the right thing, even though it was painful for you at the time. An example in order to illustrate this is if you think about an employee who stands up to his manager or his boss in a meeting, for example. So you can imagine you have a meeting with 20 people there. The boss is saying that they want to do this certain thing with the business, and everyone else in the room is just nodding their heads agreeing. If the individual employee stands up and says that, no, I think you're wrong, to the manager, that's going to cause quite a bit of short-term pain for that person, because they're not only standing up to their boss who has authority over them, they're also standing up against all of the other people in the room who are following the boss. But to go through that short-term pain and stand up for what is right, over the long term, that person will will earn the respect of all of the people around them when it turns out that the manager was in fact wrong. I guess it sort of comes back to being able to go against the majority, even though it's painful in the short term, in order to do what is right so that you can benefit over the long term. And that applies in investing, but it also applies in many other areas of your life.
And then I feel that I was raised by people who thought it was a moral duty. Be as rational as you could possibly make yourself. And that notion, which was just inherited basically from my genes and my surroundings, has served me enormously well.
The second principle here from Charlie Munger is that it is your moral duty to be as rational as possible in as many circumstances as possible. And this basically means that you need to be able to not turn a blind eye to logic, to rationale. You always need to dive in and make sure that what you're doing or the facts that you're relying on make sense logically, that they're based in rationale. When you're making decisions, whether it's investing or in other areas of your life, it needs to follow a logical set of principles. You can't just rely on the information that has been provided to you by someone, even if that someone is the majority in one circumstance. Charlie Munger then speaks about how a part of being highly rational comes from having something else, which is radical truthfulness, from telling the truth and really just not lying to yourself or to other people consistently. And he draws an example he speaks about, but I want to draw another example in the finance world, which is all of these fund managers who all together have been drilled into their mind since university and all through their corporate career that something like modern portfolio theory makes sense. That is, it is the only way that you should approach investing, even though there are very, very successful investors such as Warren Buffett or Charlie Munger and a ton of other value investors who can present very rational and logic facts to these people. These people, because they've been lying to themselves for so long and because they've been lied to by all of the people that are around them, they start to believe their lies as truths. And in those circumstances, there is no logical or rational information that you could show them that they would then change their mind. It's so ingrained in their mind, and that is a quick way in order to not gain success over your life, by lying to yourself consistently to the point at which you believe the lies that you're telling. And for those who don't know what I'm talking about when I say modern portfolio theory, well, it is the investing philosophy or strategy that most fund managers use these days. And among other things, it suggests that the price volatility, how quickly a price changes, impacts the risk of the underlying business, or of the stock and therefore the underlying business. So in that theory, if you had a business that had zero debt, tons of cash on the balance sheet, it was in a great industry that's growing over time, it has distinct competitive advantages, it's a major player, it has one of the best management teams of all time, well, if that great business had a sharp stock price movement down, then modern portfolio theory suggests that that business or that stock, I should say, became more risky. It was riskier. Whereas a long-term or a value investor would kind of question the logic or the rationale of that and say, well, hey, if it's a solid long-term business, even though their stock price went down sharply in the short term, wouldn't you think that because the price of that great business that isn't going anywhere is cheaper, wouldn't you think that the risk has actually gone down? The reason why the risk has gone down in a great business when its stock price goes down is because the business then needs to generate less profit in order to make you a good return. If a stock price is at $100 per share and then it drops to $50 per share, then that company needs to return to you half as much profit in order to satisfy your return, because you're paying half as much. So a rational person, a logical person would draw the conclusion that if a business is strong and stable and it has great prospects and it meets all of the other requirements of a great business, if its stock price goes down, it becomes less risky. Whereas modern portfolio theory is this fantastic theory that all of these fund managers use, even though they can't outperform the market, that suggests that that business has become more risky and that you should sell that business and acquire one that is less risky. And I know that I just went way off track from what we were talking about, but to sort of get this back on track when we're talking about making sure that you are consistently being rational in as many situations as possible, it just basically means that when you're making decisions, whether it comes to investing or in other areas of your life, you need to question what you're doing. You need to question the facts that you're applying, the information that you're using in order to make decisions, not just accepting information as fact or as correct and then applying it to your decision making. Make sure you go through the motions of questioning whether what information you're using makes sense so that you can make rational decisions as often as possible throughout your life. So I hope this video provided you some value and explained some of the philosophies or principles or mental tricks that Charlie Munger has used throughout his life in order to amass wealth and become successful in his own eyes. So if you did enjoy today's video and you want to see more videos like this, then I suggest that you hit the subscribe button, and if you enjoyed the video, then you can leave it a like and let me know your thoughts down in the comment section below. And just as a reminder before we finish out this video, if you are a long-term or a value investor and you're interested in diving deeper into stock analysis and joining a community of like-minded investors, a learning environment, then I consider joining Learn by Example over the next 2 weeks, because it's 30% off and it's the cheapest price that it will ever be. So if you're interested, you've been thinking about it, you're on the fence, or maybe you've never heard about it, then check out more information down in the description below. But if you're interested, I highly recommend that you take advantage of this opportunity and join up now. But other than that, thanks everyone for watching, and I'll see you guys in the next video.